Yeah, hello again to everybody. It's nice to see you back on this channel, and I hope that's rather a very courageous assumption. I hope that you can enjoy today's lecture. Well, we still talk about trade tax, and here we still are occupied or busy with some last details on the computation of Germany's trade tax trade profit. You remember trade profit was my personal translation for the German word Gewerbeertrag, which means that is that modified figure where the income from business is adjusted a bit in order to fulfill the specific requirements which result from the idea that one wants only to tax the results of a certain business and not all the 7 types of income. Well, we have already spoken about the most important adjustments to the trade income, and there are only a few positions left now. And what we have to talk about still is the donations deduction, then a certain deduction which is granted to compensate for the fact that the land and buildings which are business property are taxed by a second tax levied by the cities too. So to avoid a kind of double taxation, there is real estate tax compensation deduction in paragraph 9. Then it might be that you have deducted under the rules of the income tax some foreign taxes if you decided not to use the credit method but the deduction method. Then you treated foreign income taxes as a business expense, and it might be that you deducted things which refer to, let's say, elements of the income which are not subjected to trade tax. And so then also the expenses, also the tax, which is an expense relating to tax-free amounts, which are tax-free under trade tax, they should then be eliminated from the computation of the trade profit. And last but not least, you might also think about some other minor details, well, which I even forgot to mention here. That was, I remember that number 4 was the dividend-driven impairment expense, which is a rather curious thing which happens rarely as all the stuff here. The most relevant thing is the donations. If you tend to be generous, ladies and gentlemen, that will make your heart leap with joy, because you know there is already a donations deductions rule under income tax and corporation tax. You can make donations to charity organizations and can deduct them up to a certain limit. Now that limit under income tax and corporation tax was the higher of the two limits here. 20% of your income can be donated to charitable organizations, and you can then fully offset these donations. Or up to 4 per mil, so 4 out of 1,000 of the total wages paid plus the revenue generated from sales. The idea is that grants you a certain minimum amount of deductibility, and that gives you some legal certainty, because if you make a donation in the first half of the year and you think you have a very good profit situation this year, it might be that your profit vanishes again by losses in the second half of the year, and so you donated more than you could. And so the 4 per mil rule gives you a certain certainty that you can at least deduct a certain amount before you know the profit of the year. You should know that the 20% is calculated on the income from business, so not on the trade profit. And income from business here means the figure which results before you deduct the donations. Okay. So here you take, for the 20% computation, the figure which is relevant for income or corporation tax. and not the thing which is resulting, oh my God, my English, which results from the calculation of all the adjustments in 8 and 9. So one might basically expect that these things are the same, because 20% of the income and in income tax and 20% of the income from business in trade tax seems to be the same, but surprise, the conditions which must be met for the deduction of a donation are not always identical. They are not completely the same. So you can't rely on the idea that what you could deduct as donations for income tax or corporation tax can be also deducted in the identical amount for trade tax. And so, for example, one of the additional conditions is that the donations must have been made out of the financial means of the business. So you need to use the cash or bank account of the business to donate. If you do it from a private bank account, which a natural person could do, then the donation does not refer to the business, and so it will be ignored during the computation of the trade profit. That's one of the first suggestions which a tax advisor might have to give a client, if that client is a natural person in Germany. Never make a donation from your private bank account if you want to have it deducted from the tax base, because if you want to deduct it from the tax base, you should deduct it from both income tax and corporation and trade tax, and that's only possible if the business bank account or the business cash is used for making the donation. So, as the conditions in general are different, you cannot rely on that the things are identical. To illustrate that, here is an example. Imagine there is a business owner. You have income from, or you are, I should dream a bit. You have an income from business of 1 million and a loss from lease and rent of minus 500,000. So under income tax, you can deduct up to 20% of your income. Now your income is only 500,000. The profit minus the loss. So here the 20% limit is 100,000. Now, if you look to your limits under trade tax, you see 20% of your income from business here are 200,000. So that directly makes clear that you have different limits with relation to the different taxes. For these reasons, you have here demanded by law or by practical reasoning also a two-step calculation approach. First, you reverse or revert all the donations deduction, which has been booked as expense for the purpose of income taxation, or even if you booked donations fully as expense, you would have done that perhaps if you made donations, let's say of 30% of the income, you naturally booked all of them. You revert first all the donations expense and add it back to the profit. Then in the second step, then you calculate the allowed limits, and then you can deduct within these limits the donations which you made. The first step will usually be only necessary for a corporation, because only for a corporation everything which they spend is a business expense. In case of a natural person or a partnership, a donation is usually regarded as a privately motivated expense, so it will be made by the owner of a business as a private person. So there the books will reflect a donation to the Red Cross or to a university as a withdrawal of that money from the enterprise and spending it in the private sphere, which makes the trade profit idea that the money must come from the bank account rather strange, because then you have to withdraw the money from a bank account and then spend it as a private person, but that's life. So you have that two-step approach. You should further remember that here, as in the case of income tax and corporation tax, if you do donate more than is deductible in 1 year, you can carry forward the rest and deduct that rest within the limits of next year. So if next year your 20% limit is not fully used up, then you can fill it up with the undeducted rest of donations of this year, which has been confirmed to you in form or attested to you in form of a no donations carry forward. So to illustrate that, an example. Imagine a GmbH has a profit of 600,000. Now, when a town in the neighborhood was hit by a natural catastrophe, when a dam broke and the whole town was flooded with water and mud, and so, yeah, you need some imagination. A donated now enormous amounts of money, 200,000, that's not a trifle, for the German Technisches Hilfswerk, that can be perhaps translated with the Technical Emergency Assistance Network, a charity organization similar to the Red Cross. They have machines and heavy trucks and all that, and if there is a catastrophe, they go there and help with their devices and with their labor until problems have been solved, simply, and obstacles have been removed, and so they have heavy devices and beggars, trucks, lorries, and everything they need to help in such a case. Now, that was your motivation as a GmbH. You had a catastrophe nearby, so you donated more than usual, and naturally you booked that donation in your books, and you booked it as expense because it's money that went away. Now, the wages paid were 800,000 euros. Sales revenues amounted to 9,200,000. That information is necessary to calculate that 4 per mil minimum amount. So, what can we say concerning the treatment of the donation under trade tax rules? First, everything has to be reverted or reversed. You cancel the expense posting and say, or you add it back. Originally, there were more than 600,000, there were 800,000 profit. Now you can calculate the limits. 20% of 800,000 is 160,000, or 4 in 1,000 for per mil of the total of wages plus revenue from sales. So in our case, that was 4 per mil, or 4 on 1,000 out of 10 million, that's 40,000. The higher limit counts, so that's here 160,000. So we have a look on how much did you pay. You donated 200,000, that's more. So the limit cuts off the rest and you can deduct only the 160,000. The remaining 40,000 are turned into donations carry forward. You can try to use them next year or the year after next year or on your 90th birthday. The only thing which you can never do is you cannot pass over your unused donations to your children when you die by last will and testament. That's unfortunately not possible. But apart from that, you can carry it forward indefinitely. By the way, not so really indefinitely, because you remember that tax is levied on the business and not on the owner. So what happens if you made a donation from the business account of your bakery in year 1, you had a huge donations carry forward, then in year 5 the bakery goes bankrupt, and in year 8 you open up a shoe factory? The answer is, well, when your business dies, the donations carry forward dies with the business, because the shoe factory is a new tax object. That's formally not the same business as before, so that will be a new tax file and everything starts from scratch. So that would be clear. Okay, second example, imagine now a sole trader B, and the abbreviation EK in Germany signalizes this is an eingetragener Kaufmann, that means sole trader. And BEK is a business, or the person is a business owner. And B has profit from business of 1 million and income from lease and rent of 200,000. B had made donations to the Red Cross of 100,000 and donations to the university of 180,000. The donations to the university was made from the business bank account, and the donation from the Red Cross from a private bank account. So there is a donations carry forward left over from the previous year of 100,000 for income tax purposes and only 15,000 for trade tax purposes. And the total revenue from sales was 20 million, wages paid were 5 million. Now we have a mass of confusing information and try to mumble ourselves through. The first step is you reverse the expense deduction during the computation of income from business. That's not necessary here because we have a natural person, and natural persons don't book donations as business expense because that's generosity is something which only your private part or private half shows. The business half of a person is greedy and orientated towards profit. So only a GmbH, which only has a business sphere, must have, by definition, a donation as a business expense. All the others have private expense here. So no necessity to reverse that. So the profit remains 1 million. Second step. Now let's calculate the limits for the deductibility. 20% of income from business is 200,000. The lease and rent naturally is for trade tax ignored. 4 per mil or 4 in 1,000 of 25 million is 100,000. The higher limit counts, that's 200,000. So what did we donate? Only the payment to the university counts here for trade tax because only that donation was made from the financial means of the business. The rest was private bank account, that doesn't count here. 180,000 can be deducted. Last step, we think now of the remaining gap. You still have 20,000 left over, which you can fill up by other donations. And here the donations carry forward comes to your mind again, and you say, well, there were some old donations. I have got them certified from the fiscal office last year as a donations carry forward. So I also put that tax notice on the table and say I also deduct that 15,000, which I have for trade tax purposes. So total deductibility is 195,000, and so we have left over a total profit from business, which counts for trade tax calculation of 805,000. Third example, and afterwards 3 is enough, ladies and gentlemen, so don't fear too much. ABC OHG has an income from a shop, 500,000, and from rent of houses, 100,000. ABC OHG made donations because we ordered them to make donations, otherwise the case would be without any interest to us. So we told them, make some donations of 150,000 to acknowledge charity organizations. Take the money from your business bank account because otherwise you spoil our case. They did so. Now the total of wages plus revenue from sales they had was 35 million, so respect. They have no donations carry forward to make our lives simpler, as we can always assume if no such carry forward is explicitly mentioned. Solution of the case. ABC OHG has a profit from business of, surprisingly, 600,000. Why? Because they are a partnership, and a partnership which has at least one business activity under German law is treated as if all their activities are deemed to be income from business. So Also, the rent income is income from business in their case. You remember that from General Introduction to Tax Law and from the partnership chapter of this lecture. So, yeah. Then you do not need to make the first step because the donations have not been booked as a business expense. They are a partnership, so natural persons, and they don't book it as a business expense, but as a withdrawal. Now let's compute the 20% limit, that 120,000, but the 4 per mil out of 35 million are 140,000, and surprisingly, the higher limit counts again. So what we have is we can deduct 140,000 from the trade tax relevant profit. That is laid down in 9 number 5 Gewerbesteuergesetz, so Trade Tax Act, and the remaining amount will probably end up as a donations carry forward. Okay, that's it. Next small item where we have to think about corrections still. The municipalities in Germany do something which also cities in England, I believe, do, and in many other European countries, they levy a tax on real estate property. That's a very old tax. The owners of land were taxed on the value of the land with a fixed percentage. The justification or inner idea which underlies such a tax is if you own a building, you can usually earn a certain rent income. Or if you live yourself in that building, you save rent expense. So in both cases, you have either revenue, or you should be able, that's far better, you should be able, you can be expected that you have the ability to generate an income of, let's say, either 8,000 or so, or to increase your income by saving expenses by 8,000, depending on the value of that property. So the real estate property tax is a kind of tax on the expectable profit from a building. Now the problem is when you have a building in your business property, the actually earned profits are a part of your trade profit. And so the city would end up in taxing one and the same profit twice. The first time, they would tax it via the real estate tax. They would tax the profit which one reasonably can expect you to make. And then they would, a second time, tax the profits which you really made, actually made. And that would mean you tax the same amounts twice. And in order to correct that, you see, Germans are always very interested in principles and basics. And so somebody found out and they said, that can't be, it's a contradiction. To say, first, you should have earned 8,000 so we can tax that. Second, you really earned 8,000 so we can tax that again. Somebody realized that, and so they said there must be a compensation. And there were only two possibilities. Either we renounce on the real estate tax for business property, or you say, no, that spoils the whole functioning of the real estate property tax. And so then you need to give compensation within the trade tax. That is where the legislator decided for. So the law allowed a deduction of 0.11% of the real estate tax value of that property, which belongs to a business property. Probably the real estate tax is only, let's say, 1% or 0.5% or so, or a very small amount on the tax value of the business, because the real estate tax is a kind of a property or wealth tax. They ask you about the market value of your building and then assess the tax as a percentage of that market value. So that explains the relatively low amounts which are taken into account here. However, the rule as I wrote it down here is only applied this way from 2025 onwards. There is an older rule which will remain in force till the assessment period of 2024. That is a bit more complicated, and that rule says that until the end of 2024 the deduction will be still calculated on an older variant, an older form of standardized market value for real estate property tax purposes. The other formula is you can deduct 1.2% of the so-called Einheitswert, so standardized tax value of the real estate property, which belongs to the business property of the enterprise. And as that standardized tax value was last fixed or last assessed in 1964, or in certain parts of Germany in 1935 for the last time, these values are a bit outdated. And so some years or even decades ago, the legislator said as long as this is not yet corrected up to present market values, we use that Einheitswert or that standard tax value of 1964 only with an adjustment of 140%. So the additional 40% were a kind of standardized adjustment to inflation. Naturally, that's far too low, so probably that was done some 10, 20, 30 years ago, and nobody ever later cared about the later increases in the prices. So that was, by the way, one of the reasons why the Federal Constitutional Court, that is the Supreme Court of Germany, the Constitutional Court, which has as only institution the right to overrule a law and declare it void, that the Federal Constitutional Court said the market values are so far away from the tax values that the tax can no longer be justified as fair and equal. And so that is the explanation why, with effect from 2025 onwards, there has to be a new system where for the real estate property tax, market values have to be assessed and found out again. And so that is the reason why this new rule then, the black one, or the bold type one, then will be applied in the future. Well, so that's it. There are some very, very few cases where an enterprise can, instead of this very standardized rule for compensating the real estate property tax, can indeed deduct all actual revenue from the real estate property in question. Now, in practice, that extended deductibility of or extended compensation rule for real estate property tax is very, very hard to obtain because the conditions are very, very restrictive. It can only be granted for enterprises which only and exclusively achieve revenue from real estate property or from monetary investments. So if you, for example, let a factory building to somebody else, then you will have the idea that and this is your only activity, that the only thing you did was letting real estate property to somebody else, so that all your revenue comes from real estate. Now the fiscal administration will have a look on the case and say, well, But in your factory building, there is also built in an elevator for heavy loads, and this is a machine. And the machine is not intangible, is not immovable property in the tax law perspective. So your revenue comes from partly immovable property and partly from letting machines for rent. So it's no longer coming exclusively from immovable properties activities, and so you don't get the extended deduction. That's usually how it ends. So we don't need to memorize this thing. By the way, naturally, all the details of a German trade tax, you will have already felt this. That's not so decisive for people who are going to work in the international field. On the other hand, just to say that plain and simply, you can use your knowledge of trade tax to understand some developments in international taxation. Surprisingly, because as I told you in the beginning, what was the underlying problem of that trade tax which triggered all these adjustments in 8 number 1? That people could shift money from the business to another sphere, especially the private sphere, where that money was later out of scope of the taxation. And now when you look to what happens in the international tax planning field, you have a similar structure. Here, trade tax, a business could always in history shift money from the business to the private sphere, and then the money was gone for trade tax. Counterattacks had to be made by the fiscal authorities in order to keep up and sustain the tax claims. So they said certain expenses can no longer be deducted. They must be half or at least a bit added back. And now if you compare that, what you learned in trade tax, and compare the situation to international taxation, does something come to your mind? Do you understand something? Do you see parallels? For example, what did you learn about income tax and corporation tax? License fees. Very often money which has been earned in Germany is transferred in form of license fees to other countries where it's lowly taxed. So it's out of scope of German taxation, although the money was generated here. Counterattack. There is a kind of a license barrier under development in German law, and in other countries we have similar approaches. Interest can be used to shift money from one country to another country, and then it's gone. Development in income taxation during last decades, interest is restricted in deductibility. There is an interest barrier and more things going on. And so you see, an understanding of trade tax is not completely senseless. Because if you have a closer understanding of trade tax, you see, hey, we have here a similar situation, and we have had it already for decades or centuries in the area of trade tax, which we now have in the international field. Money can be taken and shifted to other places out of scope of taxation. And here you see what developed over time as a sustainable or nearly sustainable solution to preserve the tax potential or the tax revenue. And you can even prognostize what is going to happen, or you can have certain suspicions where things are going to happen in the future. Just look on 8 number 1, the list of add-backs. This is probably a good list of how you could shift money to other states. And just depending on the frequency of how often these possibilities will be used for cross-border shifting of profit in the future, you can really expect that the list of 8 number 1, Trade Tax Act, will in the long run also be a list, show up again as a list of non-deductible expenses or expenses where the deduction is limited on a worldwide scale. So what we are doing here is not only learning some details about a strange, outdated, uninteresting German tax, because we are not dealing with Germany. No, this what we are doing here also can give us in the long run some insight into parallels in historical development. So just to give you that remark, if you have the feeling he's talking about completely uninteresting things, I am from Cameroon, I am from South Africa, or I even am from such faraway countries like Bavaria, I'm not interested in trade tax, then, by the way, if you are from Bavaria, you should be. So if you have the feeling, I'm not interested in that, well, you have to learn that not without any reason. It's a good idea for a local tax. You see how it works, and you can draw some insight and conclusions in the long run from knowing these details. Yeah, another detail was foreign taxes can sometimes be deducted as a business expense. There were 4 methods for the elimination of double taxation, which we know, at least which I know fluently. The first one is the exemption method, then there is a credit method, then there is a deduction method, and the last one would be the waiver or lump sum method. And now, if no other method can be applied, usually the last resort which you have is deductibility of the foreign income tax as a business expense. And now it could be that you deducted foreign taxes from income from business, although these foreign taxes relate to a revenue or a part of your income which is not covered by trade tax. In that case, the revenue would be free of tax and the expense relating to that revenue would still be deductible. That can't be. Usually you treat revenue and relating expense correspondingly. If revenue is tax-free, expense cannot be deducted. To clarify that, the legislator added an adjustment rule in 8 number 12, which says if somebody deducted foreign income taxes, that part of the foreign income taxes which is combined or connected to an amount which is tax-free or not taxed under trade tax will be revoked for trade tax purposes. That's a bit abstract, so I can imagine that you can't imagine a concrete example where that could really happen, because trade tax says only income from inland business is taxable. And now if you pay taxes for a foreign permanent establishment or so, and then deduct that foreign taxes from the profit of that foreign permanent establishment, then it's already out of scope of trade tax, also that expense. So very hard to imagine an example in practice. And now here, ladies and gentlemen, surprise, I tried to find one, and I could honestly not find a single example where I can imagine this situation really to happen in practice. It might be that it is perhaps only, a clarification or something which wants to avoid that some formalistic law expert says, the law says you can deduct the foreign taxes from your income, without seeing the natural thing that naturally if you deduct foreign taxes during the computation of your income, that you deduct these foreign taxes from the income to which they belong. And so if they belong to a non-taxed amount under trade tax, then you deduct them from this, and so they stay automatically out of scope of trade tax. Probably it's only a clarification, but I do not know. My imagination after some years is not wide enough and good enough to imagine a concrete example. Perhaps in the course of next years we are going to find one. I'm looking forward to closing that gap in my knowledge and would be happy if oh, in some years we stumble over a concrete example. Good. The last thing is, the last adjustment is the rollback or reversal of a so-called dividend-driven impairment expense. Now you can probably not understand what that might be. I, as a student, could never. So here we have a short explanation what happens and what is meant here. You buy a 100% participation. It also works with a 10% participation. It also works with 5%. It doesn't really matter. Just to make things clear, 100% in the GmbH, you buy that for 100 million. Market price of today. Everything was correctly valued. There was no tricks. And so its present market value is 100 million. You paid 100 million. Now that GmbH has retained earnings of 90 million. That is why the price was so high. And now, after you paid that price, you said, well, I have now a huge credit in the bank, or I want to avoid that. So this GmbH has 90 million retained earnings, and so I could distribute to shareholders, it could distribute to shareholders 90 million. So it shall do so. So you order the GmbH to make a profit distribution of 90 million. Now, common sense says, if the GmbH before had a value, so a property of 100 million, and now it gives 90 million of the 100 million away, then it can afterwards only be poorer by 90 million. So only 10 million value will be left. And that, ladies and gentlemen, what does that mean for the value of your shares? You bought them for 100 million, but now, due to the profit distribution, the market value of the GmbHs dropped down by 90 million to 10 million. And so your shares can only also have a value of 10 million from now on. Consequently, your cost of acquisition of 100 million for the shares is now too high as a balance sheet value. So you would have to make an impairment and write them down to 10 million. And this will cause an expense in the books of 90 million. So in principle, you got a revenue from the dividend of 90 million plus, and you have an expense from the impairment of 90 million minus. Now you know already that dividends can be tax-free under trade tax rules if you have a participation of, do you still know it, 15% or more. So that would mean you get a dividend revenue of 90 million, which is taxed not at all. It counts for trade tax with 0. And so the expense of 90 million lowers the rest of your trade profit. That was regarded a bit as unfair from the perspective of the fisc. By the way, in the long run, when you sell the shares later, the gain from selling them will be fully taxable, so it would in principle be debatable if it's really unfair. But at least it gives you a great liquidity advantage that you get 90 million cash without having to pay taxes, and that you can directly write off 90 million as expense from tax. So that is what was not wanted, and so they say, in such a case, the expense shall be cancelled for trade tax. By the way, always when you receive a dividend, the market value of your shares drops down correspondingly. But usually, the market value is far higher than the cost of acquisition. And you have huge hidden reserves in the value of the shares. So usually the dividend lets only drop down the hidden reserves, and you usually do not end up in a region where the book value has to be lowered. So such a dividend-driven impairment usually happens only in the time very near to an acquisition of shares, so it's relatively rare. But several firms had done a similar model, and so people saw the effect and wanted to block it by a special rule. Okay, so that were the most interesting adjustments which the Trade Tax Act demands for the income from business in order to arrive from the income from business to the trade profit. So the final thing which we need. Please, if you want to keep the overview, remember this 8 number 1. There is the dividend and the partnership profits adjustment rules, and there is these trifles which I spoke about today. And you should first think about the adjustment, and then you know, will it push up the profit or lower it? And the things which push up the profit, which increase it, are all listed in paragraph 8. The other ones are paragraph 9. So there you know where you have to look for. Good. And a last remark. As in case of the income tax or corporation tax, there is a loss carry forward. And the basic mechanism is also the same as on the income tax. First, you can deduct up to 1 million without any modification. The first 1 million of your trade profit can be fully offset against old losses. And 60% of the remaining amount can also be used to set them off against the loss carry forward. So although the rules seem to be identical, the amounts which are in play will not be identical, and that is why the whole thing is regulated differently, and you have to calculate it differently. Because why? Well, in income tax, the loss carry forward results from the losses which remain after the results from all 7 types of income have been added up. In trade tax, only the income from business counts, and so only from income from business can a loss carry forward result. The second difference is the loss carry forward here is not based on the income from business, but on the trade profit. That is the adjusted figure which results after the application of all the modifications in 8 and 9. So all the adjustments which we had in the last 2 lectures and this one. If the trade profit, after all these adjustments, is a loss, only then you have a loss carry forward. And that's far more rarely the case. Furthermore, there are some additional contrasts or differences. First, if you are married under income tax and you have a joint assessment, then your 1 million first step is doubled. A married couple can together use up a loss carry forward up to 2 million. That's not possible for trade tax. Here, the business is seen alone, and here is only 1 million under all circumstances applicable. On the other hand, what you cannot do under income tax is you cannot have a loss carry forward first step of 1 million for each individual business which you own. Here you can, because as you remember, every business is taxed separately, is a separate tax object and a separate tax file and tax declaration for trade tax. So if you have a bakery and a shoe factory and both have a loss carry forward, you can use up the first million of the bakery for the loss carry forward, and you can completely separately from that also treat the shoe factory. And if you have there a loss carry forward, you can also use up the first million of the trade profit of the shoe factory for the loss carry forward. Naturally, only the loss carry forward from the shoe factory because these are two different tax cases. And a further peculiarity and difference is in income tax, you have also in a restricted extent a loss carry backwards. So you can say, I made a loss of, let's say, 1 million this year, and I want to carry it backwards into last year. So to let vanish my income from last year, I change my tax assessment from last year then. Originally, I had an income of 800,000. Now I make a loss carry forward, and so my income last year goes down to zero. So I get all my tax payments of last year refunded under income tax, and that is a great help for my liquidity because I get a part of my tax of last year back. So it's direct financial help to an enterprise in crisis. That's not applicable for trade tax. The simple reason is that there are many small cities and municipalities. Very often you have one big enterprise in the city. And now imagine your one and only or your biggest taxpayer last year paid, let's say, 1 million or taxes on 1 million. Let's say that were 200,000. You build a school from that. No, well, school is more expensive, but you did something from that. So you acquired a building from that for some purposes. And now taxpayer comes, knocks on your door and says, I want my money back. Now you can only say the money is no longer there. Look over the street. There is a small little building. Or there are some traffic lights in the streets. You can have them. That's not feasible. And so as the cities would probably not be able to give back that money, the rule is such a city tax does not change the past assessments. Here, the rule is simply no loss carry backwards, only a loss carry forward. So we have a considerable amount of differences here. Okay. So that is what you need to know about all the loss carry forward things. And you remember, please, the last information which you need to know, that if the owner of business changes, the loss carry forward falls away. So that's the consequence of different legal rules in different cases. If you have a sole trader, then change the owner means you have a new business, so a complete new case. If you have a partnership, 10A of the Trade Tax Act says the loss carry forward is proportionally related to each partner. If you exchange one partner for another, then that part of the loss carry forward where the partner is changed is cancelled. And in case of a GmbH or AG or other capital company, there is a rule in the Corporation Tax Act which says if you exchange a majority of shareholders within a short time under certain circumstances, that can and will often result in a complete cancellation of the loss carry forward because the thing seems to be a tax abuse. And under the same circumstances, also the trade tax loss carry forward would be cancelled. Okay, so that is what you need to know about that. And I think that was enough for today. So we know now nearly everything which we need in practical cases to compute the trade profit. And naturally, the next things we have to talk about will be how do you come from the trade profit to the final trade tax, especially in cases where an enterprise has permanent establishment in different cities, so that not only one city, but more than one city is interested in taxing, let's say, the prey, so the trade profit. Thanks for watching. I'm glad you survived this rather lengthy lecture. Hope you are going to survive successfully also future lectures. Hope you come back and hope that you did not forget or will not forget everything of the lectures to know. Thanks for watching. Please come back to the channel. And don't forget, if you like the channel, recommend it to others urgently. If you don't like the channel, recommend it to others urgently too, but to the people whom you don't like, and have some fun. Okay, in all cases, would be happy to see you back on the channel. Thanks for watching and goodbye.